This is On the Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On the Charts podcast, episode 194 for Friday, 12th of May, 2017. US stocks traded lower and the Dow extended its losing streak to 3 days. Macy's reported a disappointing drop in profit, sending its shares 17% lower and dragging the consumer discretionary sector down with it. Nordstrom and JCPenney followed suit, both falling 7%. And Snapchat, which we discussed last night, plunged 20% after announcing a slowdown in user numbers. Energy shares traded higher after oil rallied 1%, and it was disclosed that OPEC will roll over the November output cut agreement for a further 6 months. Prices were also helped from a fall in US stockpiles. In Australia today, prices started off subdued but slowly started tracking lower following yesterday's inability to hold early gains. Banks were all on the back foot, losing between 0.5% and 0.75%. BT Investment Management fell another 4% after declining 6% yesterday. Alumina was a standout performer at the top end, adding 5%. The materials sector was the only one to really hold in green territory as gold stocks held their bid. Consumer discretionary infotech sectors both declined 1.8%. At the close, the broader market was down about 0.75% and testing the lower boundary of a rising wedge pattern. We've mentioned the potency of these patterns before, and a downside break opens up for a swift move down towards 5,600. Transurban is taking a pause, but the strong trend that has added 30% to the share price since October has just got a little ahead of itself. The company is popular with analysts and investors due to its high defensive qualities and its steady dividend. The operator of main tollways such as CityLink and the Hills M2 offered little surprises in recent investor briefing. It reiterated that it remains focused on growth products. Its balance sheet is strong and improving customer services. One thing that most analysts concur with is that the stock is fully priced, and from a technical standpoint, we can see some short-term downside potential. However, that should lead to a buying opportunity sooner rather than later. Last week's high came within a whisker of new record highs. However, as has been pointed out in many prior episodes, the first attempt at breaking into new high ground usually fails, so it's no surprise to see prices retreating right here. The trend progression to this point has been good, and we now expect a period of sideways consolidation with some downside bias. The downside could extend down to $11.50, yet keep the longer-term trend pattern completely intact. We're going to be monitoring the decline, and if it meets our criteria, then a buying recommendation could be made to members. The large cap growth portfolio has been a consistent player in Transurban trends and is currently maintaining its long position. And Ramsay Healthcare is one we've been watching, and in our latest coverage suggests an upside bounce could see prices hit the reversal zone between 73.10 and 75.50. Well, yesterday's high was 73.92, right in that zone, and today the stock has started slipping, down 1.2%. The company's favoured amongst analysts in the sector, citing its pharmacy network continues to expand rapidly and escalates long-term growth. Currently, the company has 22 pharmacies across Australia and should benefit from the continuing ageing population and also the expectation that public hospitals will expand their outsourcing needs. The departure of the CEO has now had a muted impact, although some headwinds from tariff reductions in Europe could dilute next year's growth numbers. As mentioned above, the technical outlook remains in a corrective bounce after prices dipped from 85 mid last year down to the mid-60 zone in March. The bounce to date has only just begun. The second phase portends some near-term weakness that should see prices now dip towards $67 to $68 and before reasserting itself on the upside. We don't expect new highs to be made anytime soon, so any strength will just provide a trading opportunity. And just a reminder, starting Monday, this coming Monday here at the Charters, we're going to have a special week of looking at multi-year charts for longer-term market direction. This analysis is brought to you by the same guys that called the top of the market in 2007 and called almost the exact low in March 2009. We'll be covering all the major global indices, including Australia, all the main commodities that drive Australian share prices, and of course your favourite blue chip stocks. This is big picture stuff, but only available available to members of the Chartist Pro. If you're not a member, head over to thechartist.com.au and join our 2-week trial. Remember, Special Reports Week starts this coming Monday, exclusively just for members of the Chartist. My name's Nick Radge. Have a great weekend. I'll see you on the charts on Monday.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.